Hi, I'm Jimmy. In this video, I'm going to walk through my top 3 dividend stocks from the materials sector that could help give us the passive income that could help us get towards our goal of financial independence. Now, since this is a global platform and diversifying our portfolio with dividend stocks from other countries could be helpful to almost all of our portfolios, well, I thought it would make sense to include 3 dividend stocks from the US and 3 dividend stocks from Europe to help get more opportunity or more options in there for each of us to go out and research. Now, this video is part of a new passive income from dividends series where we're putting together the top 3 dividend stocks from each of the 11 global investment classification standards. This video focuses on the materials sector, and then we're going to go right down the line covering each of them. Now, in this particular video, like I mentioned, we're testing out adding 3 European stocks. Let me know in the comments below if you think that's a good idea. Should we go further with that or just leave it with US stocks? Please let me know what you think in the comments below. Okay, so to make this list, obviously we wanted stocks that paid good dividends, ideally dividends that have the potential to grow or at least be maintained over the next couple of years. And I also looked for companies that could continue to afford to pay their dividend. And for that, what we used was the dividend coverage ratio. A dividend coverage ratio is when we take the profits of the company and we compare that to the amount of dividends that company paid. The more the company earned relative to the amount of dividends that they paid, well, the higher the dividend coverage ratio. Clearly, the higher is better. So we made sure that companies look like they can afford to continue to pay their dividends. Okay, let's jump in with the first dividend paying stock. Our first US company is the International Flavors and Fragrances Company, ticker symbol IFF. Basically, what they do is they create, manufacture, and supply flavors and fragrances for food, beverages, personal care products, household products, things along those lines. Their products are used in things like perfume, soaps, some foods, some beverages, and a long list of products. But I'm sure we all get the point of basically what they do. They provide the fragrances and the flavors to companies to manufacture their products. Now, I like IFF because it seems that they have some defensive nature to their business, which could ultimately be quite useful if we're worried at all about a stock market crash. Plus, when we look at their dividend, well, we can see that dividends have grown nicely over the past few years. And as we can see with analyst estimates, those are the green bars, well, it seems that dividends are expected to continue to grow over the next couple of years, according to analysts. Right now, their dividend yield is just short of 2.5%. Now, when we add earnings per share to this chart, that's the orange lines, well, clearly earnings per share is much larger than the blue bars, which is dividends. So clearly they look somewhat capable of paying their dividends using nothing more than just the profits that they're currently earning. So that's a good thing for almost any dividend stock. Now, I also want to point out that here I use adjusted earnings per share. Adjusted earnings per share can be much more useful than stated numbers because adjusted numbers either add back or take away certain profit or expenses. Maybe they sold a piece of real estate, or in the case of this company, they had fees from an acquisition that they had made last year. Well, since that was true, and clearly those numbers are outside the normal course of business, unless they make a new acquisition, those fees won't exist. So you add back those fees, you end up with a higher earnings per share. If they had sold real estate and it looked like a profit, you would deduct that. Either way, that's what we have there. That's what we're using throughout all of the charts. We're using adjusted earnings per share. Okay, our next company jumps over to the London Stock Exchange, and it's a company called Johnson Matthey, ticker symbol JMAT. JMAT is one of the leaders in the refining and distribution of the gold, silver, and platinum metal groups, among a whole host of other things that they're pushing for. Now, they've been around since the early 1800s, and as we can see with their dividend chart, clearly they've been fairly consistent. And when we jump in and add earnings per share to this chart, well, here, just like all the other companies on this list, it seems that Johnson is doing a nice job of covering their distributions. So it seems that their 2.5% or so dividend yield is quite safe. We'll come back to them in a second. But for now, let's jump over to the third company on the list, back to the US. And this is a dividend stock that has a slightly higher dividend yield. Up next, we have LyondellBasell Industries, ticker symbol LYB. LYB has a dividend yield of almost 4.5%. And what they do is they manufacture plastic, chemical, and fuel products. And like I said, they have a great dividend right now. And when we look at their dividend per share chart, well, the company, after they dropped their dividends per share back in 2013, well, they've been growing it fairly nicely ever since then. And then when we add the earnings per share to the chart, well, it makes sense that they would have lowered their distributions from the 2012 level, since back in 2012, well, the dividends were getting relatively high compared to how much profits they had. So clearly the drop in dividends gave them more breathing room, and I wouldn't be surprised if they're able to at least maintain their current dividend growth rate for the next couple of years. So I like that one. Okay, back over to the London Exchange for a company called Anglo American, ticker symbol AAL. Now, Anglo American is a global mining company which includes mining for things like iron ore, copper, nickel, things along those lines. Now, this company is actually closely tied to the last London Exchange company that I mentioned, Johnson Matthey, and because Johnson Matthey is the sole marketing arm of Anglo American's Platinum division. Now, we might ask, why include two companies that are so closely related? And the real reason I did this is that this company has a higher dividend yield at it's about 4.4% compared to Johnson's 2.4%. So I know what we're thinking. If Anglo has a higher dividend yield, why include the other one at all? Well, for that, we have AAL's dividend chart. And as we could see, it's been a bit less consistent than all the other companies that we've looked at so far and going forward. Now, when we add earnings per share to this chart, we can see that the volatility of their profits or their earnings is closely tied to the volatility of their dividends. But ultimately, I actually like this business because I think that this business should do fairly well over the next couple of years. And I think that Anglo has the possibility of meeting or at least falling closely in line with what analysts are estimating on both the profit and on the dividend side. And if that happens, well, it seems that their dividend is likely safe over the next few years, and the 4.4% could add a nice diversifier to our whole portfolio. Okay, skipping back to the next US stock, here we have Eastman Chemical, ticker symbol EMN. Now, Eastman Chemical is an international chemical company that produces fibers, plastics, and chemicals. They have a dividend yield of about 3%, and when we pull up their dividend per share chart, well, we can see clearly they've been growing quite nicely over the past few years. And we mix in earnings per share into this whole thing, well, we can see that their 3% dividend yield seems quite safe. In fact, I could easily see them ramping up the pace that they're increasing their dividends by. So with that in mind, I think that this seems like a fairly stable dividend stock. Okay, now we have one of the more dynamic companies from a trading perspective on our list, and that's Rio Tinto, ticker symbol RIO. Now, Rio Tinto is available on the London Stock Exchange. It's also available in the US under the same ticker, and Rio Tinto Limited is listed in Australia as well. So we can get this company from a whole different angles. Now, in London, Rio has a dividend yield of about 6.3%. In the US, they have a dividend yield of about 5.7%, and in Australia, it's slightly over 7%. So clearly, it pays a good dividend. So Rio is an international mining company, and they have interests in mines that mine everything from aluminum, coal, copper, gold, iron ore, diamonds, uranium, silver, zinc, and the list goes on and on. So this is what their dividends look like going back to 2012. And here I'm focusing on the London stock. All the other stock exchanges, they look similar. Neither one is, there's no particular exchange that was significantly better or worse. So when we add earnings per share, well, broadly speaking, it seems that Rio Tinto has done a good job of covering their dividends outside of the 1 year. But going forward, I would expect for them to continue to at least maintain their dividend. So once again, this is one of those high dividend stocks that could make a good addition to most dividend portfolios. Now, if you're interested in more high dividend stocks, real estate investment trusts, or REITs for short, well, they can be a great place for many of us to start. So if you're interested in learning more about REITs, I actually did a REIT primer video, and that could be a great next video for you to watch. There's a link in the description below, and you can link right here. So feel free to check that out if that's interesting to you. Besides that, thank you so much for sticking with me all the way to the end of the video. I really appreciate it. And we're going to do more dividend stocks for all the other sectors coming up soon. So don't forget, hit the subscribe button, hit the thumbs up. Thanks for sticking with me, and I'll see you in the next video.